Is the party over? Central banks around the world appear to be shifting course toward tightening up on the liquidity faucet. Is the writing on the wall? And if so, what does this mean for DIY investors like you and me? Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com, and you can subscribe to this podcast at iTunes, Stitcher, and the Google Play Store. And as always, if you'd like my detailed show notes from today's episode, simply text the word family notes. That's one word, family notes, to the number 44222. Or you can also go to investinthefamily.com and simply sign up there, and you'll get these notes as well as all my other sign-up bonuses that I've ever come out with. So that's pretty cool. And again, on today's show, we're going to be going through Randall Forsyth's Up and Down Wall Street column from Barron's magazine. And this week's article was titled "Send Back the Clowns." And that title is not really going to relate to what we're talking about today, because that's kind of an off-topic thing that he tried to bring into his article, and I'm not really going to get into the notes of that. But that's the title all the same. So I hope you're going to enjoy today's show with me talking about Randall Forsyth's Up and Down Wall Street column from Barron's magazine. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. If you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investinthefamily.com/policygenius. That's investinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. So, Randall Forsyth this week talking a lot about central bank activity around the world and the idea of taper tantrum 2.0, as he refers to it, which basically the subtle suggestions that we seem to be getting from central bankers around the world that after 8 years, they may begin to be moving away from crisis policies. For example, crisis policies such as ultra low interest rates, such as massive securities purchases, basically with the click of a button. And it's the type of stuff that medieval alchemists would be very jealous of. People who were trying to turn various metals into gold, basically create money out of nothing, which is something that central bankers have been doing a lot of over the recent years. And so those are the type of policies that it looks like they could be moving away from. And basically, a lot of these policies have been less than impressive, but some academics will say it's because they haven't been administered in strong enough doses, which to me seems insane. And anytime I see something that says academics say, there's very few scenarios where I don't automatically get extremely skeptical, because the term academic is usually applied to someone who is sitting around reading and thinking a lot, which is fine, and honestly it describes me in some ways in different aspects of my career. But I hope that I'm sober enough to know that it's in the trenches of life, it's in the details and in the actual living out of things where I believe real wisdom is found. And so if academics are saying that the reason that these crisis level policies from central bankers have not been impressive is because they haven't been administering them in strong enough doses, that seems insane to me. That's like saying, well, this isn't working, let's just do more of it. Where does this come from? Former Treasury Secretary Lawrence Summers, that's Federal Reserve Treasury Secretary Lawrence Summers, recently endorsed the Federal Reserve purchasing corporate debt and equity securities. That sounds even more insane to me. And apparently Fed chairperson Janet Yellen has said this would not be out of the question in a future crisis situation. So now there's been a lot of buying of government debt. Now they're talking about buying up potentially corporate debt and even corporate equity securities. So it just sounds like they just want to continue to do anything but deal with the real issue. Let's just keep covering things up and pushing the can further and further down the road. It blows my mind. I get the idea of in a relief scenario, you want to come in and bring relief type aid to stem the bleeding and stop some kind of cataclysmic or extreme negative event from happening. But that doesn't take 8 years. I've spent a significant portion of my life working in the areas of international development. And there's a process that you go through in international development. There's different stages. There's relief, there is rehabilitation, and then there is development. And basically the idea is relief is crisis level, emergency, life-threatening situations. You enter in and you do whatever it takes to stop the problem. Then you have rehabilitation, where basically you're getting people to a place where they can start working, they can start solving problems on their own and get to the development, which is a longer-term process of developing people to be able to solve their own problems. You're walking alongside them, and as much as possible, you're not doing for anyone what they can do for themselves. And so if you apply that same scenario to the Federal Reserve or central bankers around the world, they get a massive F and failure in terms of how that's been applied in recent years. Again, maybe originally early on something was needed, but they have well beyond that. And we could talk about that for hours as far as implications of that and how that, I think, is fouling up lots of asset pricing and our perceptions of true economic health in America and around the world. So that's something to be aware of with all of that. But along with that, agreeing with me, or maybe I guess in reality I'm agreeing with them, the backlash against these policies has been brewing from outside the academic and mainstream economist fold. Thank you, because those are not the places where I feel like these level decisions should be made. For example, British Prime Minister Theresa May has come out and said similar to what I just said, that maybe some of these policies were needed at the very beginning, right around the crisis itself in 2007, 8, 9, and that time period, but that at this point they're not helpful anymore, and if anything, they're causing more trouble. Presidential candidate Donald Trump has been very harsh in his words against Janet Yellen and the U.S. Fed, saying similar things as far as it's all a political backing and that it's not really helpful and things like that. But again, that's Donald Trump, so make what you want of that. But also central bank leaders appear to know, they no longer seem like superheroes. If you go back and look at historically how Alan Greenspan was viewed, and even Ben Bernanke was viewed. I think he won, was it Time Magazine Person of the Year one year, a few years ago or something like that, or back around the time of the crisis. Mario Draghi, the chairman of the European Central Bank, has been referred to as Super Mario. There seems to have been this mindset of, hey, these are the people we can rely on. These people can, quote unquote, save the economy. But that superhero mindset and view seems to be fading significantly. Central banks seem to be considering a fundamental shift in policies. Bank of Japan is a great example. A few weeks ago, end of September, they made some announcements that they're going to begin targeting the yield curve of Japanese government bond market, aiming for 0% on the benchmark 10-year Japanese government bonds. So again, depending on how broad and how well you understand debt, bonds, and all these dynamics, this could be a little bit confusing. But essentially, this is a shift from targeting a quantity bond purchases to targeting a price. So basically, instead of saying, we're going to buy this many billions of dollars or yen worth of securities, we're just going to try to get the yield to 0%. And then once we're there, then we're not doing anymore. So in theory, this could mean a reduction in purchases, assuming targets are met. The European Central Bank is also considering gradual reduction in securities purchases. And obviously, the U.S. Federal Reserve continues to talk about rate increases. And in a moment, we'll talk about the possibilities of a rate increase of maybe 0.25% as soon as December 2016. And this has been recorded in early October 2016. Jeffrey Gundlach, you may know his name from investing circles. He is a very widely respected and well-known investor. He commented recently at a conference, and he's commenting on the growing belief that interest rates will, quote unquote, never rise. And his response to that was saying that anytime someone says something can, quote unquote, never happen, it's probably about to happen. And that was his argument, was that don't fall into that mindset because there's a really good chance that rates could be rising soon. And he went on to say that zero or negative interest rates are doing more harm than good, and the decline of Deutsche Bank is an example of that. And bottom line is you can't help the economy by bankrupting the banks. And obviously very low interest rates place a lot of pressure on financial institutions. For these reasons and more, Gundlach believes that the low in bond yields have already been seen. So basically the low is in, according to him. And that was basically when the 10-year U.S. Treasuries fell to 1.36%, or the yield did, post-Brexit. That he said that is the low. So that's pretty big news in my opinion. That's something to be aware of in terms of bond pricing. And again, what that means moving forward, it's hard to say, but significant things to be aware of and to keep in mind. So there appears to be a major trend changes at hand around the world, especially in the, I'll say, the more developed economies and their central banks. Michael Hartnett of Bank of America Merrill Lynch, he says that we may have experienced peak liquidity. The shifts in thinking and policy by the Bank of Japan and the European Central Bank reinforce this. Theresa May's critiques of QE reinforce this. The potential Fed hike in December reinforces this. Hartnett goes on to say that we also may have experienced peak inequality and peak globalization, which all leads to peak returns from financial assets. So basically, peak liquidity may be behind us, peak inequality, which obviously a lot of critique of QE and these crisis level financial policies, monetary policies, is that they have created massive financial bubbles that have made the rich richer and have hurt the poor because they're not actually helping the economy. So peak inequality may have been reached, as well as peak globalization, because around the world you see a lot more nations turning inward and taking care of themselves as opposed to, open arms, let's all work together. And my thesis continues to be that as long as the global economy struggles, we'll have more and more inwardly focused government policies and political policies and otherwise, because people are going to continue to say, well, I'm going to look out for number one. As long as this pie is shrinking and the economy is struggling, I'm going to make sure I'm taken care of. That's the mindset that will prevail. And so the idea of peak globalization is probably true. At least in the interim or near-term future. And then also, he said that then that would all lead to the idea of peak returns from financial assets. So that's the bad news. There's kind of, I guess, any of those could be bad news depending on your view. But if peak liquidity, peak inequality, and peak globalization have been met, then that very likely will negatively impact returns from financial assets. Hartnett's group from B of A, Merrill Lynch, recommends investing in Main Street over Wall Street for 2017. So that means small caps, that means commodities, that means real assets, for example, collectibles and even real estate over financial ones. That means banks over capital markets, and even suggests a shift away from bond proxies, for example, away from utilities, away from telecoms, away from REITs, and away from low volatility stocks. And kind of in relation to this bigger picture theme, Beijing has been selling foreign currencies significantly of late in order to prop up the yuan, which is their currency, which bolsters its value, which is the complete opposite of driving down currency value deliberately, which is the whole currency war idea, where you've got Japan, the US, Europe, China, these major global currencies, devaluing their currencies through low interest rates, through monetary, through QE, basically quote unquote money printing. But here you have Beijing doing significant policies to do the complete opposite of weaken their currency, actually strengthen the currency, which is another sign that potentially these individuals could be correct about shifts in direction of global central bank policies. Concurrently, the Fed appears on track to raise rates in December. According to Bloomberg, the probability is 64.3%. I have no earthly idea how they came up with that number, but it's more than 50. And so the probability, and actually I believe even last week or the week before, it was in the 50s. So according to them, Bloomberg, the probabilities of a rate increase in December are increasing. And bottom line is major central banks appear to be becoming less generous. So in summary, we could say the party may be ending. So fascinating stuff this week, a lot to consider regarding shifts in trends for central bank activities around the world. And again, it's one of those things where bottom line, we don't know what's going to happen. There could always be some kind of a black swan event that could shift thinking. If there is some kind of a black swan, the event could be all kinds of things. It could be something like the concerns around Deutsche Bank currently, as far as whether or not the bank is as financially sound as everyone wants to believe it is. It could be some kind of global conflict, any kind of major currency disruption or central bank disruption or economic disruption. There's lots of things that could happen that could lead central bankers back to more of a crisis type concern. But I do think that in the near term, it does seem that central bankers are thinking, hey, if we don't pull back on this a little bit, we're going to be that much further up the creek. For example, with the Fed, if they keep saying we're going to raise rates, but they never do it, then the power of saying we're going to raise rates, there's no power in that anymore. And people aren't going to respond to that anymore. and people aren't going to take them seriously anymore. And that goes for any of the global central banks. So I do think it would not surprise me to see central banks, including the Fed, making decisions in coming months that is much more of a tightening, reducing liquidity, just to see, can they get away with it? Because they want to move in that direction. And so, first of all, because they want to see how strong the economy actually is, they don't want to be supporting the economy. And in the event there is another crisis in the future, they want to have some kind of ammunition to pull out of the war chest in that event. And all of that precludes that there's some kind of tightening taking place right now. So I tend to lean in that direction. I would not be surprised to see the Fed raise rates in December. It could be the last time for a long time, but who knows? But in the end, this is talking points and my summary conclusions from Randall Forsyth's Up and Down Wall Street column from this last week. It was dated October 10th, and today's October 10th. So how about that? So I hope you enjoyed today's show with Investor in the Family Radio. And as I'm going over Randall Forsyth's Up and Down Wall Street article, if you enjoyed the show, don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. If you want to receive my summary sheet highlights from this show, simply text the word Family Notes to the number 44222 or visit investorinthefamily.com and sign up. And we'll make sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.